Right now, India's banking sector is witnessing one of its best times in terms of profitability and asset quality. But have you been seeing all these headlines about banks running out of money and struggling to raise funds? Now, there are tons of articles out there talking about it. So let's break this down in simple terms. But first, how does a bank actually work? Now, banks take money from regular folks like you and I in the form of deposits, and in return, they pay us a little bit of interest. This is where they get the funds they need to lend out to people or businesses who want to borrow money. Now, when they lend us money, they charge a higher interest rate than what they pay us for our deposits. This difference is how they make a profit. But banks don't just stop at giving out loans. They also invest some of our deposited money in things like bonds, and these investments might not make as much as money as loans do, but they can be sold quickly if the bank needs cash in a pinch. And just to be safe, banks also keep some money in reserve according to RBI requirements. Now, for banks to keep lending money and keep the economy growing, they need deposits to grow at the same rate as the loans they give out. But right now, banks are facing a big problem. They're not getting enough deposits. Now, this is what's causing the headlines about a deposit crunch. In India, bank credit, which is the money banks lend, is growing at 13.3%, but deposits are only growing at 11.1%. The gap might not be huge, but it's been the third year running that deposit growth in India has lacked in credit growth. So why is credit growth outpacing deposit growth? Well, there's a deposit war happening. Banks are fighting not only against each other for deposits, but also against things like stocks, mutual funds that people are now preferring over bank deposits. Now, more people are investing directly in the market because the returns are better, and technology has made it easier to do so. In fact, household share in bank deposits has dropped because people are simply looking for better ways to make their money work harder. Now, the RBI Governor Shaktikanta Das pointed out in July 2024 that this lag in deposit growth compared to credit growth could cause long-term liquidity problems for banks. So what are banks doing to deal with this? Well, they're trying a few things. First off, they're offering higher interest rates on deposit to attract people. In fact, more than 2/3 of fixed deposits are now earning 7% or more, according to the RBI. Now, some banks are also turning to things like certificates of deposits, which are kind of like fixed deposits but for companies to raise money. Then there is securitization, where they bundle up loans and sell them to investors, bringing in more cash. Now, some small lenders are also teaming up with fintechs to offer more flexible products. You can now get fixed deposits without even opening a full bank account and borrow money with flexible limits tied to your deposits and other extra benefits. So yes, banks and financial companies are getting creative to bring in more funds and keep lending. And that's why we are seeing the gap between deposit and credit growth slightly narrowing now. But what can banks do to attract more deposits? Now, one big issue is that banks have been slow to raise deposit rates, and higher interest rates are always a good incentive for savers. Now, a lot of people have shifted their money from bank deposits to other investments like mutual funds because, let's be honest, everyone's looking for higher returns. And deposits are actually pretty tax inefficient. From day one, your interest is taxed according to your tax slab, and they even deduct tax at source before your deposit matures. Now, what's next? There's an interesting report from our SEBI-registered that talks about how historically there have been periods where the growth of credit and deposits didn't match up, and this could last for 2 to 4 years. According to them, this credit deposit gap will probably end around June to October 2025. Now, at the end of the day, banks will need to balance how much they lend versus how much they have in deposits to avoid liquidity issues. It's all about keeping that credit to deposit ratio in check. Now, if you want to know more about how this will impact banks' profitability, do leave a comment below. Having said that, this is me, Merlin, signing off. Take care and stay invested.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.